All right, YouTube, what's good? Welcome back to my channel. I haven't made a video in a while. Looks like my only really popular video is where I broke down the cryptocurrency Ohm and kind of, clearly stated that it was a bit of a scam. We have yet to see if it'll play out furthermore in the future because there's still, Ohm is still an organization that's doing things. So, maybe I can do a follow-up video. But anyways, that's more of an aside. Right now we're going to look at the DXY, which if you don't know what the DXY is, DXY, it's the dollar currency index. We're going to get some of this noise off the screen here. So you can see as the Fed started raising rates in 2021, the demand for the dollar went up very, very sharply, as you can see. And that's because the interest rates going up would dictate that banks and organizations need to have more dollars on deposit to fulfill the demand since the interest rate is going up. So let me show you what I mean. So if we go to let's look at the 2-year yield. So the dollar currency index was so strong because the yield you could get on dollars by putting them in a bank reached almost 5%. Now a 5% quote unquote risk-free rate of return on the dollar is still pretty good. Despite the dollar backing off, and we know that the BRICS nations are creating new currencies as we speak, and central bank digital currencies are right around the corner. Despite that happening, the demand for the dollar actually ended up spiking this whole past cycle since 2021 because of the rates going up so quickly. I mean, I know people that have, 1 year and 2 year treasuries that they bought around here, and they're getting around 4.5% to 5% for those treasuries. Now, that might not sound like a lot, but if you invest $1 million into treasuries, which, a lot of people have a lot more money than most of the people, looking at trading stuff on YouTube. Let's just be real, guys. There's a lot of big fish out there that can make big moves. And, if you put $1 million in at 5%, you have a really great return over the course of 2 years. And, if you think about it, equities are kind of selling off or going sideways right now. I think the market is, more risk off than it was obviously before the tightening. Okay, if it's going risk off and we can get 5% for the next 2 years by doing basically nothing but buying U.S. treasuries, okay, that's pretty good. It's at least some sort of strategy. I mean, we know that inflation is actually higher than 5% right now. And, I don't even know if I trust this number, 6%. But you can see inflation peaked here in June of 2022, and it's been backing down. But that's only been backing down this much because they have increased rates so much. So it's kind of a big, silly system they got going on. But, if you look at the chart of the dollar, it looks pretty similar to the inflation rate or rates. So what I'm saying is the strength of the dollar is very much determined by interest rates, inflation, and I would also say at this point by other countries' plans to use other currencies. And I'm talking about the BRICS nations specifically going to some sort of gold-backed central bank digital currency that they use for settlement, or some settlement in the yuan, or something like that. But let's go ahead and put back on some technical levels. So if you can see this line right here, we're going to change it to be red. So, I don't want the whole freaking graph to be red. I just want this line to be red. Oh, that's the actual, okay, no. So we want this line. Pardon me. We're going to get this line to be red, and we're going to make it big and thick too. Okay, this is an extremely key level of support and resistance for the dollar currency index, DXY. That's what we're focusing on right now. You can see let's just take it from 2008 because that's a really good starting point to try and understand what the dollar's been doing. So there's the 2008 market crash. Okay, here's 2001, 2000. Here's the dot-com era. You can see the dollar precipitously backs off all the way down to 71 on the DXY. Down here, that's its ultimate low in 2008. And since 2008, it's been moving up. If we turn candles on so this channel looks a little bit better, and we turn logarithmic on so this channel is a bit more clear. You see this upward channel that I've been drawing right here? This is kind of the channel we've been in since 2008. But right now what I really wanted to highlight was this red technical structure area right here. About 103 has been really a key moment for the dollar throughout all its history. You can see back in 81, you broke above, retested it, and then formed more ultimate highs. And you encountered a little bit of resistance here. There's not many technical levels up in here because the dollar hasn't really ever been that high. You can see I drew another one right here, but ultimately this time we didn't go up as much. We're gonna delete all this to make the screen less busy. But you can see a couple of the important technical levels here. So the last spike in the DXY was back in 2001. We got up to 120. Honestly, with rates being what they're at, you know, it's really hard to say what's going to be going on. But I really just wanted, like, macro-wise, you know, there's too many variables for me to tell you, oh, the dollar is going to go up for the next 2 years. Like, anyone telling you for sure it's this way or that way, you know, is probably kind of bullshitting you. But if we look at this really important level, get rid of this one. This red line is what I want us all to focus on right here, 104. You can see here, here, and if we go way back here, the DXY has used this 104 level many times as resistance or support. So all through here it was resistance, resistance, finally broke off, it was support, support, support here, then broke down, and then you get a big breakdown. Back in 2017 you touched it up here and then moved down, touched it up here in 2020 and then moved down. Now we're breaking above, or we broke above, now we're breaking back below. So it'll be really interesting to see if we can hold this. This red line right here, which has been, you know, a key level in the past, and then B, if you see this blue line right here going up and down through this whole channel right here, you can see we're actually just touching, we're sitting, this weekly candle is sitting on it right now. So it'll be interesting to see if the middle of this channel holds the support and you do something like this, maybe move above, or you fail and then move back down to other levels, maybe you go back up like this. I really don't know. All I'm saying is the structure of this channel going upwards, this one like this, and these different technical levels are really clear to me. So right now, I think with gold doing so well, the dollar seems to be backing off. And I would probably look for sort of a continuation pattern. If you can't get above this 104, if you can't break out of this downward trend right here and do a little something like that, then I would be looking to short the dollar, which technically could be good for Bitcoin, gold, and equities, but that's also sort of a speculatory element. Okay, and then we're going to go to what I've been using to do that, because if I'm going to point that out, I might as well freaking tell you what I'm doing about it. So this is UDN. This is the bearish DXY ETF. You can see we don't really have a lot of chart history here. It only goes back to 2008. If you remember that red line that I was pointing out on the DXY, this one right here, corresponding line to that on the inverse of the DXY, which is UDN, would be this level right here. So basically what I'm waiting to see is if the bearish ETF of the dollar will break this resistance line, or we get some more capitulation, basically like below this sort of box right here. I may have moved it around, but you can see what I'm saying though, right? Hopefully you can see what I'm trying to say. We have a technical high, another local high here, and then we used this entire area as support to create this structure. Now you're sort of wedged between these two levels. You can see those local highs here on UDN. Then here was that kind of sort of head and shoulders thing. So really, I'm waiting to see if either of these levels can be broken. And then, so right now I'm short the dollar. I guess I should go ahead and just tell you. I'm short the dollar. I think it's going to do something like this, where it's going to go and go back up this way and keep going back up this way until ultimately something different happens or something else changes. But I'm not really a bull on the dollar. It made sense to own a lot of dollars up here, right? Because we know when the dollar currency index was up here, we were able to get, about 5% in U.S. Treasuries if we bought U.S. Treasuries, in March, or we bought them, maybe in October or January. You can see, and I'm not saying you wouldn't do this right now. Money is obviously coming risk off and rotating, but you can kind of see that yields, in my opinion, have sort of peaked, which also would suggest that the DXY has sort of peaked, because remember this massive uptick in yields actually creates a rush to the dollar, because we need, capital investors are like, we need yield, right? But the equities market is looking too risky right now, so we're going to put our money in something relatively safe, which it's all relative. So relatively, they're going to be looking at the dollar. Okay, and they're going to buy U.S. Treasuries. Okay, you can get around 5% on that shit right now. But as yields start going back down, as the yield curve starts to uninvert, and you can see this is the inversion right here. This is the 2-year divided by the 10-year. There was the ultimate peak of the curve right up here, which is just a whole lot, 1.28. That's 28 basis points, unless I'm using basis points incorrectly. I don't know all the lingo still, but that kind of looks like a shoulder, that kind of looks like a head, and we could be making another shoulder here. Then eventually do something like this, funnel down this way, go down, and then we break, and then the big fucking capitulation in the stock market happens. I still think there's going to be a recession in 2023, and I'm going to be monitoring this yield curve uninversion very closely. As you can see, this yellow line represents 1.0 right here, so this would mean that the short end of the yield curve is no longer inverted above the long end. So I'm waiting till we get some sort of cross down below this, and as you can see, I've denoted every time it is touched then crossed on this chart. You can see we have this yield curve inversion sort of tool that I made. It goes all the way back to 89. You can see every single time we had the yields uninvert, denoted by these vertical blue lines here. And if we just take this and we let's add the S&P 500 to this. So this is pretty much everyone knows what the S&P 500 is if you know stocks. So we'll go to, we don't even need to go to compare really. Okay, yields uninvert here. Okay, we get the dot-com bubble, and the S&P goes down 48%. Okay, here's the 2008, 2009 housing crisis. Yields uninvert here. Okay, eventual market peak, crash. And here we have COVIDs, the plandemic, scamdemic, Wuhan virus, bullshit WEF program, whatever you'd like to call it. We have that one right here. We had a big flash crash right after yields uninverted. It took a minute, as you can see. And sorry about the scaling. Every time I move the wheel, it changes the scale. So what I'm looking for this time is I'm going to make another big blue line like this. As soon as this 2-year divided by 10-year leaves the 1%, I'm going to mark it there, and I'm going to say, okay, wherever that may be, maybe it's here, maybe it's here, maybe it's over here, wherever that is, okay, I'm going to wait till yields drop down pretty quickly to help me find maybe where the eventual bottom of the bear market is. Now this bear market I think is interesting because as you can see, our top was way over here in December 2021, and we've been going down since, sort of going sideways more recently. But the yield curve hasn't even uninverted yet. That's pretty interesting to me. That would tell me that we have a lot more pain to go if yields still haven't uninverted. Anyways, I'm sure you've been lectured on the yield curve before, but this is just a visual representation of it. I don't know when it's going to uninvert, but I'm not going to be piling into equities until that happens. And, you know, big capital isn't going to be doing that either when it can get frickin'... Oh, let's get this off of there. Big capital isn't going to be doing that either when it can get frickin' 5% on a frickin' savings account or on T-bills. You know, okay, maybe the interest, sorry, excuse me, not the interest rate, the inflation rate's like 6%, and, you know, we can get 5% in a bank right now. You know, that's still a better loss. That's a better pill to swallow than sticking it in anything in the NASDAQ right now, in my opinion. Obviously, you've had some up weeks, but, you know, from its all-time high, the tech stocks are still down 22%, and they're kind of just going sideways. I mean, look at this. You're right here. When was the last time? First time you were touching these levels were January 2021. Okay, that's over 2 years, 811 days, and you're still not above. You still haven't made any progress on where you were at in March 2021. So that kind of shows me what equities are doing right now and why money is moving into less risky things like U.S. Treasuries, okay? Well, because if we're 0% for the past 2 years on this, and I can turn around over here and get, at one point about 5%, that's obviously better, okay? And I can tell you big companies around the world are going to be looking at less aggressive strategies like this for the future because they definitely have they have nerds like me sitting in rooms creating technical reports on the yield curve and explaining that when it uninverts, you get the bulk of, the actual recession, unemployment going up afterwards. So I still think we're headed to a recession. I still think we have some time to let this play out. I did want to cover one thing really quickly. I did a video on this previously on my channel. We're going to look at oh my gosh, there's just so much up here, guys. Sorry. Where did it go? Okay, we're going to look at the financial sector. Excuse the mess over here. We were doing some speculation. Let's get rid of this. This is the XLF, which is the financial sector of the S&P 500. And I covered a short strategy on this with the ticker FAZ. And if you were following me on this channel, I was letting you know about FAZ back in October, which is over here. I believe the date was about October 26th maybe. But I started telling you about FAZ over here. Ultimately, FAZ, and for those that don't know, this is Financial Bear 3X shares. Okay, so it's the inverse on sort of this index, right? So when this goes down, FAZ goes up, all right? And I was telling you about this for a long time, all right? We've known about Credit Suisse. We've known about some of these other banks with shit assets on their balance sheet, and we know that, their debt is coming, was going to mature. I personally, myself, figured that Credit Suisse was going to be bought by UBS, and I made that call back here to some private colleagues of mine based on some information we had that we gathered back here in October, actually. And that ended up being right, how long was that? 173 days earlier. And you can go check my YouTube. I was talking about this back in October. Anyways, I followed my own advice, and I got to enter this trade down here, FAZ, for about $15 my stop was pretty bad. I was pretty nervous when it was getting down here. I thought I did something wrong. Got to be honest with you. Thought I did something wrong on the trade when it was down here. But look, boom, boom, boom. You had one touch, and then you broke out of it, and then you sailed back up. Anyways, I'm not here saying I told you so, but there was at least one video where I was actually right, and I did provide some value to you guys. So I'm hoping I can do that in the future. Just wanted to do a little recap of that. FAZ was a great trade for me. We exited up here. Well, I exited up here about $25.10 because I knew this was unsustainable. Because if you go look at the RSI, which I do not have pulled up. All right, well, we'll just say it from the MACD terms. You had a MACD crossover there. We'll turn this onto the 4 hours so I can show you more detail. Yep, you had your MACD cross right here, so I knew about, I figured it was going to cross because, look how high, look at these technical levels on the MACD in previous spikes. Right there, MACD got up to 1.71. Okay, MACD is above 1.89 there, so okay, good exit. And this trade might continue to play out. It looks like it might be turning over now. If I see something like this, some sort of consolidation pattern, it might go up like that. This would be like some sort of bull flag or pennant sort of structure. If it comes in like this, maybe, and it does maybe something like that. I don't know. We're gonna find out though. That's for sure, people. So stay tuned if you want to know what's going to happen with the financial sector. So what that would look like on this would be something sort of like that, and maybe move to the other end of this channel. We shall see. I'll be monitoring this. If you guys want more specific videos, let me know in the comments. I don't really have that many subscribers right now, but I'm trying to make videos because this one specifically, if you would have followed my video back in October, you actually may have been able to make some money. Like, no joke. So that's kind of cool. So I'm going to try and start doing this YouTube stuff a little bit more. Anyways, love you guys. Peace out.